Hi, this is Ashish and I'm happy to welcome you to the next edition of Know Your 4C Manager. This is a series where we interview managers who are in your portfolio and bring them closer to you. Today I have somebody who's a known face in equity capital markets in India. He has experience of 2.5 decades and he managed a very successful fund for about 10 years, the IDFC Premier Fund. It chalked up a stellar performance of close to 22% over this decade. He then went on to start his own firm, Old Bridge Capital, where he's garnered close to about 3,000 crores of assets and has again raked up a reasonable track record. So I have with me today Kenneth Andrade. Kenneth, welcome to this show.
Thanks, Ashish.
First up, Kenneth, I know that Old Bridge, the name, has a very interesting story which you mentioned when we met a year back. Could you tell us, why the selection of the name?
Well, it steps back into the way we actually look for businesses and invest. So if I had to articulate my investing style or our investing style, we try to look for businesses that have reasonable amount of value, completely out of favor. And that gives you a lot of value orientation in the entire business. So when you're looking for a name to wrap it around this investment philosophy, we came across a small example of how ancient bridges in Rome were constructed. They were always, and at the inauguration of this ancient bridge, the engineers were made to stand under the bridge. With life at stake, all these bridges were over-engineered. They were meant to last extremely long periods of time. And that's what we try to do with our portfolios. We try to look for businesses which are durable, which have longevity and have come with a reasonably large margin of safety. So that's how we put the name together, Old Bridge.
No, I love the analogy. I mean, basically build longer lasting portfolios and skin in the game where you make the engineers stand under the bridge. We've had a very interesting 2018. I mean, if I look at it point to point, it looks like nothing has happened because, the large cap index is up, the yields are where they are. Crude has cooled off towards the end of the year, but we know that's far from the truth. I mean, if I look under the hood, there has been a carnage in the broader markets. We've had huge FX volatility. Any thoughts about last year? I mean,
well, it's one of those few years where the deviation was among a lot of asset classes was fairly large, and this was during the year, and then even at the end of the year, if you put a lot of these things together, you would see the differences that have happened. And I think you go through these volatility phases once in a while. All said and done, it hasn't been such a bad year as far as the Indian environment is concerned or the corporate and the economy is concerned. It's been a reasonably volatile year as far as asset prices are concerned. So if I had to put the economy at one side and I have to put asset prices at the other side, I think there's a deviation in the way the two behaved. And I think that's playing out in terms of what portfolios have done. So if I just address just one part of it all, the economy and corporate India, I think everything has become much better than where we left it off in 2017. 2017 March, we were in the process of deleveraging. 2018 March, we deleveraged even more. 2019 looks like we'll hit reasonably low debt as far as corporate India is concerned. Demand, infrastructure growth, consumer behavior, etc., are better than what we left them out in 17. And I think that's a consequence of how the economy is actually shaped up. We all knew we were heading towards an election, and elections are usually a period wherein government balance sheets and fiscal scope are usually under stress. And that's what we saw in the last elections. This is essentially what we're seeing in this election. I wouldn't really worry about 2018. I think we more or less consolidated our positions as an economy. We brought down debt considerably as far as corporate India is concerned. We've been able to address the macro details as far as the liabilities are there. We've seen market share shift from weaker players to the stronger franchises that are there. And more importantly, I think when we put 2018 back, I think going into the next decade, I think solvency, the issues that India had or corporate India had or investors had, that companies would disappear or become bankrupt, I think that's no longer there. I think the risk of solvency is no longer there with corporate India. That's one way of actually putting it together as we go into 2019.
I think you've touched upon few of the points. I know that you have an interesting sheet that we look at whenever we meet. What is that sheet telling you? I mean, about earnings and the way forward for Indian corporates.
In a single sentence, don't look at a headline number, because if India is growing at between 5 to 7%, you can pick your number each side. Demand exists at between 5 and 7% in terms of absolute volume. And as capacity gets exhausted, profitability growth is going to be dramatic. You saw the first leg of it happening in 2018, wherein towards the end of the calendar year, you're seeing reasonably large growth in profitability. So profitability matrix is improving quite significantly. I think that's one takeaway that I take away from that sheet. You will not have a re-leveraging, or you would not have a full-blown capex cycle right now, simply because there is a reasonable amount of more capacity that is there on the ground. So till that gets utilized, some part away from a full-blown capex cycle in India.
Right. So Kenneth, I've seen your philosophy evolve over the last 12 odd years. I remember being associated with IDFC whilst you were there. Could you tell us a little bit about your journey and how your investment philosophy has evolved, and some examples that have worked for you, whilst you were at IDFC?
So my fund management experience, my portfolio management experience started off in 2004. I happened to manage a portfolio called, which basically had a predominance of MNCs in it, multinational company fund. In that putting that entire product together, I had a universe of 50 companies. So you had to optimize the box that you were put in. Okay, India still at that point in time had close to about 350 to 400 companies that were investable. From what I had to do, I had to box myself in 50 companies. I think that was the first learning experience, is how to optimize the box. And then as it evolved itself over the decade and a half, you try to put yourself into a box. First you have to find that box, and then put yourself inside the box, and then optimize all around it all. And that's what we try to do consistently. I hit pay dirt, or as an organization we hit pay dirt in 2007 to 2008, 9 and then over to 12, is we were fairly light infrastructure and capital goods and everything that had to go with the building economy, and fairly overweight on the consumer spend. Now it's not that we had any vision that consumer businesses become large and they would have a multi-year 15% growth rates. What attracted us most was a decade before that, there was no supply that came in. When I say supply in the consumer business, there were no new brands there's no hyper competitiveness that was there in the market. A business available at very reasonable valuations, from between 12 times earnings to 15 times earnings. And at that point, even Asian Paints was at 18 times earnings. Or if you put a Maruti, it was at 12 times earnings. Or if you take Hero MotoCorp, it was at 5% dividend yields. So it was fairly easy to see a structure of how valuations fit in without trying to predict growth. So we were trying to buy. So what we did was buy a cyclical bottom, avoided what we saw a massive amount of supply coming in, because every contractor was growing, every order book was coming in. You had people pricing in 2015 book values on power infrastructure. We didn't know how long that would go. So it's a matter of patience to put that portfolio together. For us, 2008 happened. We didn't predict 2008. We came through 2008 because we were not there with capital intensive businesses. And then 2011, 12 and 13 happened. I think that re-establishes the fact that if you can choose your spaces well, the space does well. Incrementally a portfolio will participate with that industry or that segment expanding itself. So that's essentially how we formatted our investment thought process. And then 2011 we did NBFCs, not because we saw a multi-year run happening, but very simply they were all trading below price to book. I think there was just one NBFC at that point in time, which was Shriram Transport Finance, was trading over price to book. Everything was trading below price to book. So we saw value in that business. We saw capacity build up on the balance sheet in terms of the ability to lend, because not every business out there was fully leveraged. So that came into play at that point in time. And we did subsequent smaller format ideations in there. The big one in all of that was 2013, when we launched a small cap product out there. I think we couldn't have asked for the timing better than that.
Absolutely.
Okay. Again, the construct was very similar. We didn't go out looking for ideas to come to build. The ideas were sitting there. Everything was trading at cash on book. A significant amount of the small cap index was under stress. 40 out of 600 companies were profitable at that point in time. And we saw the opportunity play out there.
So am I right in saying that there is a contrarian streak in you where you look for spaces which are often ignored, or where momentum has been lacking for a long period of time, because you often tend to find value in those spaces?
When an industry doesn't do well, if I was an entrepreneur in a particular industry, when an industry gets a 9% return on capital employed and your cost of borrowing is 11%, no new capacity comes in. Even as an entrepreneur, I'm reluctant to put capacity in. That effectively means in a 3-year cycle or a 4-year cycle or maybe a 5-year cycle, capacity will exhaust itself. So you got to figure out as to where you want to bring in capacity as an entrepreneur. As an investor, I'm luckier because I don't have to go through that down cycle.
Right. So, I mean, the challenge here is sometimes you end up in value traps. So, how do you avoid those kind of names? Or
I've never tried to avoid a value trap. And if you've run a portfolio and you have probably four segments of the market which are of very similar construct, all you need is a 50% probability of getting it right. The other 50% you don't lose too much of capital because they're already available at a fair amount of price. So if you put those two together, okay, I will never get 100% right, and I'm a historical demonstration of all my portfolios, and when I look back in all the portfolios, our strike rates are at 60% max. So if I'm going to, I have to strive to get 100% right, but I know there will be at least 40% of the portfolio which is not going to fire for you. So I have to work towards the probability of getting that 60% right and not losing money on the 40%. What is very critical out here is you stop making mistakes. So we have gotten into value traps in the last 2 years, which is a very short period of time. We've been able to correct that. It's fairly important that you get that 60% right, which is to an extent that we've been fairly successful even in that.
Right. So coming to your stint at Old Bridge, I know that you were quite bullish on the rural theme, because I remember you mentioning that there is a lot of structural transformation which can happen over the next 4 to 5 years. However, we also hear that there is a lot of strife on the ground, and we keep hearing voices of farm loan waivers, and so how do you connect the two, and what is your let's say medium term hypothesis there?
So you take all the data that you get, and if you have to process it, the end result ends up in just one sentence. Capital getting allocated to that part of the world is definitely going to increase over the next decade. Now, if that's going to happen, what are the industries that are going to benefit from it? So if that's going to happen, then that part of the world is going to step up in terms of its contribution to the GDP. So I think that's 50% of your battle. That's one.
So you mentioned that there are 40% of the names that sometimes don't work out. Obviously, the idea is to limit the downside there. Any mistakes in hindsight that you can talk to us about, and or you've learned from, which has improved your process over time?
Let me talk about value traps that we went through. 2012, it was public sector enterprises and the public sector banks. 2016 and 17, I think 2017 was looking at it from a value perspective on the sugar companies, because earnings were at their peak and valuations were at their trough still, because earnings had spiked up. We had a format in media. Okay, and media cut across the board, whether it was print or whether it was cable networks, where the cost of building a new business was almost 2x the amount of value that these companies were getting on the ground. So we walked into both of them. So these are instances that we've gotten things out of skew. Okay, but it didn't mean that when we looked at print media, and we saw that the cash generation over a 3 or a 4-year cycle, 4-year period, steady state, would be equivalent to the enterprise value of that business. We kind of liked the argument, but what happened over the course of that is that you had a steep decline in the volumes itself. It had a lot to do with the environment at that point in time, also, and not only because of the shift of preference of users. So those are the elements that keep coming in. I think sugar, if I just look at the commodity cycle, right? In commodity cycle, and this is where sugar came in. From 2014, 13, 14, 15, I think in my previous organization we were building up everything around the commodity space, whether it was chemicals, paper, sugar, manufacturing, etc. And that's because they had pure intrinsic value. And when the earnings came in, I think what we eventually thought that they would be steady state in terms of a base level number that they could deliver, which is not the case in a cyclical business. Though we corrected, from 2014 to our exit, if I had to look at it from my exit, we were still up 3x. We were still up 3x. But from 2016 to 17, you were down 10 or 15%. So I think that's where the course correction needs to be. We needed to learn from what happened in a cyclical business.
So in fund management, one of the areas which has been less focused upon, or I don't see too much of content on it, is when do you sell, or you know, how do you sell? Do you have any framework around sell decisions?
We can highlight instances where we've gotten out right, and instances where we've gotten out very early. But our idea of selling a stock is exactly the same as it is to buying a stock. If you see supply coming in at a rapid pace, if you see your ROEs being 30% consistently for an extremely long period of time, we are very wary of all of that. To answer that, when we put Old Bridge together, and from where I came, which was a very consumer dominated portfolio, we have virtually no consumer businesses on our team.
And no financial services.
And no financial services as well, because we don't understand the valuations that where they came from. So we bought that legacy out from there and said that, okay, we understand that business very well, but we don't understand the valuations. I think one thing that we've been able to do is that when you buy a business at 15 times earnings, okay, and that business moves to 35 times earnings, the reason you buy it at 35 is very different from where you buy it at 15 times earnings. And I understand a right price. I have not seen too many great businesses execute in perpetuity. Every business goes through its down cycle, and I'm willing to wait for that down cycle to buy it at a better price.
Right. So a combination of valuation and what is happening around the business. If it's getting more competitive, capacity addition happening, etc., etc. Interesting. Kenneth, you know, one of the challenges that we face when we meet clients is this issue of timing. You know, people put money into equities when they're feeling good. They're normally feeling good when the markets have done well. And often the flows dry up, like today when people are not feeling good about their portfolios, but markets are down and valuations have corrected. Your thoughts about timing and, you know, how one should approach equity markets?
So, well, I've never got my timing right, but this is not about me. It's about still wanting to get that timing right, because it sounds great, it sounds interesting, it sounds great. And if I just look back between 2005 to 2015, and look at most portfolios at that period of time, they still delivered that 15% or 14 to 18% return. Premier did about 23 or 24% during that period of time. But if I look at it from a 2013 perspective, and I look at that small product that we had with the IDFC Opportunities Fund, over a 3-year cycle, it delivered a 100% plus kind of a return. Where would I want to be as an investor? So obviously, it's always the latter. So everyone wants to make that large amount of capital. So I think that's a debate that I really can't. So timing it's essential, but timing in the market essential is on the down cycle and not really on the up cycle. And that goes with what we do in the portfolio also. So we'd like to buy a business when it's in stress, because the more you buy stocks or more you buy portfolios which are going through a down cycle, the higher the probability of making those outsized returns that are there. And those are the only two bits that I have learned over the last 2 decades. But after a point in time, there's very little you can deal with as far as the client psychology is concerned, except for the fact of communicating that over a longer term, you will not ask questions on 1 year of negative
do you
returns.
follow an asset allocation strategy for yourself personally, or is it all invested in equities?
It's all equities.
All equities. Okay, Great. Which are the themes you're excited about going forward? Let's say the next 2, 3, 4 years. I know a lot of it is there in your portfolio. If you could just talk to us some of the themes that you like and where you're invested, and what is your hypothesis of of how these will turn out?
Again, I just go back and I just want to put it together, saying that I don't believe I can see the future, but I can definitely see what I can buy at a great price. And right now, one element of companies that exist with a very large rural franchise, that's a dominant part of our portfolio. But the one that's getting even larger in our portfolio is everything that's got to do with manufacturing and the infrastructure cycle, not the capex cycle, the infrastructure cycle. Those are the two businesses that dominate our portfolio. If I had to address the rural franchise, and we've touched upon it a little bit in the beginning, these companies that exist on the ground, financially they probably have the most perfect balance sheet that I've seen over the last 2 decades. They're still cash flow positive, and incrementally, they haven't grown for the last 2 years, but incrementally they're only increasing their distribution points and enhancing their business with lower amount of capital employed in the system. All we need to wait for is the cycle to turn around in that part of the world. And when I mean the cycle to turn around in that part of the world is demand to come back. And demand is related to the amount of capex or the amount of cash flow that's available in the cycle. So if you put that two together, I can't time it to the T, but I'm present there. And we definitely know from all the noise that comes out of the economy is that the social sector is going to be fairly vibrant, and the social sector with the rural economy is going to be even more vibrant. So that's one large dominant part of our portfolio. The second one, interestingly, is something that I've never I've avoided from 2008 all into 2013 and 14, or probably even at the beginning of when we put together Old Bridge, is infrastructure, is the infrastructure cycle. I mean, the contractors that existed in 2000 in the last decade do not exist anymore. There's a new breed of them, supply is constrained, and even the dominant ones that existed in the last decade are no longer dominant today. So what we see is visibility of order book and pipeline, and unlike the visibility that you had in the last decade, this comes with massive margins. The margins are explained because of the ability because the number of participants to a particular contract, which essentially explains that there's no supply side coming in. And it also has got to do, and no supply side has also got to do with the inability of new participants to raise capital. So you had this small period of time between 2015 to 2017 to 2014 to 2017, where you had different industrial groups trying to get into infrastructure. Most of them are not present. I can say all of them are not participating in this fresh rounds of tenders, and that's creating a fairly large opportunity at sizes that we haven't seen before. So that's as far as supply side and contractors establishment is concerned. From the government point of view, who are instrumental in actually putting these tenders together, they are looking at significantly larger ability to execute larger projects and not really looking at tiny fragmenting projects to give out to contract. And I think both ends are getting organized. So it's going to be a profitable journey, not for, we tend to believe that's going to be a profitable journey at least for the next 24 months or maybe 36 months for participants in tenders and for the government installations who are putting up these or who have tendered out these projects, because they get delivered the projects on time because the structure is much more organized in that manner. So that's dominant part of it all. I mean, I haven't seen some of these businesses so cheap for a very long period of time. Not to say that they can't go down anymore, but we just essentially trying to capture that cusp of it all happening right now.
Right. Any immediate risks or headwinds that you see on the horizon that one should be wary of, or that you are tracking?
So it comes from a portfolio context also, and it's also a risk as far as the portfolio is concerned. So we're not there in the consumer space, and we still don't own financials. I think where we are in that entire investment cycle is you needed a financial crisis to stop investments coming into infrastructure. a minor event in financial services again to turn the tide in retail. So if you look at the last decade, the entire expansion of retail spend happened because of the expansion of the NBFC on lending balance sheet. If that has to, I won't say contract, but even that remains where it is, I think the growth that you had on the consumer business or consumer-led franchises are at risk. I think that's the biggest risk to the economy that's holding up.
Do you see anything globally that worries you?
So the developed markets are constrained. Demand will effectively be muted, okay, and debt to GDPs in virtually all developing countries are at. That's a part of the world that's deleveraging itself. So the last decade they leveraged themselves back again when they had the minor hiccup that came into 2008, 2009, where they deleveraged themselves for an incremental period of time. So if that economy actually goes through a deleveraging cycle, there's lesser amount of capital that's available for asset markets, which effectively means that you'll have to tear down in terms of how you price equities. But that's an old argument. So biggest risk that's sitting out there is how do you value equities? Our traditional metrics of saying India is cheap between 15 to 20 times earnings may not be the case here.
So there could be a risk of derating in our markets in case the capital liquidity cycle reverses.
So the derating will happen if you do not step up and grow the economy. So you have to, so what attracts capital? Everything that's got momentum attracts capital. So if this economy has been able to demonstrate reasonable amount of growth and profitable amount of growth, I don't see ourselves derating ourselves. I see ourselves remaining standstill.
Right. So Kenneth, you spent like I saw about 2.5 decades in capital markets, right? Any advice or key learnings from your journey that you would like to share for someone who's beginning his investment journey?
Well, it's a long-term process, and so I started my personal investing in 1987. Never made money till 1995 because there were two spikes in the market. I got them both wrong. Okay, and there's an element of tuition fees that you, or learning curve, as you might say, that you have to go through the entire cycle. It's a fairly long process of being patient with your investing. No company with sales of 100 has sales of 200 the next year. That's not the way the process actually evolves. I mean, at every point in time, a business life cycle pauses, it consolidates itself, and then it goes back to grow again. I think that's how portfolios have to behave. So I think in the process of starting out into investing, I think you need to have patience, and that's the most critical element of a successful investor.
Right. So no shortcuts to success. One has to go through his or her own journey and learn from their own mistakes.
You have to learn from your own mistakes because every mistake is going to be different.
Or you can be wise by learning from other people.
From other people's mistakes.
Kenneth, at Motilal Oswal, we have this philosophy of creating winning portfolios powered by knowledge. So any books that you think are compulsory reads for investors or any interesting book that you would have read which you'd like to recommend?
So my investing journey started with Peter Lynch and both the books that he actually put together. A fairly light reading, and I could read it again and again. It essentially one of those few books that actually correlate how the consumer behavior or how individuals' behaviors correlated with stock price performance. And you could actually see it actually getting merged together. It's also very insightful on how to pick elements of balance sheets. There are physical examples that are there in both the books that are there. As I evolved and more recently, I think there are two books on capital cycles. One is by Marathon Asset Management that is there, and the more recent one by Howard Marks. And he explains as
Mastering the Cycle, second book that
the second book that he's done, and I think those are two books that effectively talk about how the investment journey across an industrial cycle, okay, how to pick peaks and troughs within an industry. I think both those books explain it very simplistic.
So he's one of the guys I've read and who says that you don't need to predict the future, but you definitely need to know where you are in the cycle and position yourself accordingly. Great. I think that's a good way to end the conversation, Kenneth. Thank you very much again for spending time with us. I found it a very interesting and insightful conversation, and I hope our viewers found it similar.
Thanks Ashish.
So thank you very much for watching. In case you need to write into us, you can write into us on our email, follow us on YouTube, look at us at Twitter. Thank you very much.